hedge funds across the board are in deep trouble, and there is a new data point that we must go over here in this video, as well as going over the intraday data, because some things are very weird and unexplainable that are going on, specifically with the ortex data and the option chain, as well as there are some key things as far as the technical analysis are concerned that everybody needs to be made aware about. All of this data suggests the Moass could happen by the end of this year, if not the first 2 months, January and February of 2022. So we are just around the corner, in my personal opinion, from seeing a huge price action move in AMC stock, as long as the Fed meeting the 14th and 15th go as planned. And we're going to go over all of this information here in this video, so stay tuned. Let's get into it, guys. Hit that like button for me, consider subscribing to the channel, as well as that, check out the pinned comment if you guys want to go follow me over on Twitter, and if you guys want access to all of my trades in real time. We have been killing it over there. Check that out. Both of those links pinned in the top comment. Now, AMC for the day, up a little bit over 8%. We're seeing a very volatile move, and this 200-day moving average has been pretty hard for us to stay above throughout today. We did top tick this on this candlestick wick earlier in the day, and then we did fall under this, and the 200-day moving average is at $31.52 per share. So if we can see a close above this 200-day moving average today, that should serve as a support level, and that should give us more room to climb to the upside, make our way back to that $35 resistance level we are going to have. Now, let's get into some of the other data, and then let's go over this hedge fund situation, because it is quite compelling. So the ortex data, and this is something that I really want to bring to your guys' attention, even though we're up 8% today, we're not seeing shorts covering. I think a lot of this buying activity is from people that previously sold out of the stock as the stock was going down, that are buying back into the stock, as well as the options, the puts that are running from into the money, out of the money, expiring this Friday and next week, December 17th. These puts that run out of the money have to be de-hedged for. The way that they are de-hedged for is by the market makers buying shares. As well as that, the calls are now starting to run back into the money, and there is a very low days to expiration, so you see more buying power from the calls running into the money, and like I said, the puts running out of the money. So there's two fronts of buying power that are happening today by the market makers, but we have no indication of shorts actually covering. We have return shares of 1.13 million, borrowed shares 2.57 million. Short interest change of 1.45%, and an estimated short interest of 18.61%. This is proof and an indication that the short interest is well over 20%. And here soon, when we get this exchange reported short interest data, that's going to put a lot of pressure on the hedge funds to cover on some of their short positions, because we still have a very high days to cover, 2.14 days to cover. That is extremely high when you're talking about a typical meme stock, one with a backing of retail investors like the world has never seen before. So days to cover is basically if all of these shorts, this estimated 95 million shares, wanted to be covered all at once, it would take 2.14 days to do so. That means a longer short squeeze, a harder, basically it's harder for shorts to get out of their short positions, driving the share price up even higher. So all in all, some weird things we're seeing from the ortex data, but I think they are overall encouraging and show and prove to us that the short interest is very, very high, at all-time highs. Now let's move on to that. Let's get into this hedge fund situation, and then let's circle back to the technical analysis and what I expect throughout the rest of this week. So this is actually an article from Forbes, from Bloomberg, sorry. It says Millennium Citadel winning the war to keep client cash longer. Why are you in such a desperate need to keep your clients' cash for a longer period of time when the stock market is at all-time highs? You should be sitting on massive gains. To give investors their cash back is not a hard thing to do, or at least it shouldn't be. And you guys can see right here, here's a little picture chart, whatever you want to call it, of the firms, the new withdrawal terms and the old terms. So Citadel's new withdrawal terms, 6.25% quarterly withdraw without fee. Their old terms were 10%. So that is almost a 100% increase from basically what it used to be at. So that is very weird right there. But some of these other firms, take a look at this. Millennium is now 5% of your initial investment back per quarter. The old term was 25% per quarter. That's a 500% increase, or I should say decrease, in the amount of money that you can pull out, your own money, out of these firms per quarter. Veritron, 8.33% per quarter. The old terms, 25%. Hudson Bay, 6.25% is the new withdrawal terms. Old terms were 25%. Very, very weird and alarming overall for the broad markets. I think this in general points to the over leveraging that is happening. And since the stock market has been going down and you are now getting news of all of these hedge funds changing their requirements, I think they have took massive losses on these dips throughout end of September and throughout the beginning of October, as well as just back here, the dip that we have recently seen. And I don't necessarily think the dip is over due to all the over leveraging and the redemptions that these hedge funds have seen. I think it pretty much proves to us that investors are withdrawing as much money as possible from one, Citadel, but all of these other hedge funds as well, because hedge funds, they're not very liked at the current moment. You don't want to necessarily be invested in hedge funds, because if you're a public figure, you're also going to be hated for investing in these hedge funds that partake in all this malicious activity against your everyday retail investor. So I think this is very alarming for the overall markets, but I think it does show that some of these AMC short positions are going to have to be covered for here in the near term future with all of these redemptions that are going on. Now, the over leveraging, the margin is at $935 billion, $862 million. That is a very, very large amount. You cannot discredit these numbers whatsoever. Over the past year, they're up almost 100%. And we do know Citadel is one of the most over leveraged hedge funds we have ever seen, with over an 8 times leverage ratio. That means for every $1, they are really controlling $8 of basically margin. And this is only the FINRA margin debt of $935 billion. We don't get reported the SBL loans, the securities backed loans. That number is in between 250 and 500 billion dollars. So the real margin debt outstanding, or loans against portfolios, is well over 1.3 to 1.5 trillion dollars. Very alarming. So you're seeing, as the market has went down, these losses have been compound for the hedge funds, and I think that is pretty much a given. Now, if we do get this SEC proposed rule change that is actually implemented by the end of the year, where there will essentially be a public record that we can all look at to see the actual shorted shares and the short positions, what kind of collateral these funds are using, when they took out these positions, the actual cost to borrow that they are paying. Once that gets approved, I think by the end of this year, if not the first 2 months of next year, that will also put a lot of pressure on the hedge funds to cover a lot of this short interest, because as we do know, not very many shorts actually covered during the June rally. We only went from about 14% short, 20% short interest down to 14% short interest. So I do think this time around, you're going to see just that whole level of basically FOMO head into the stock from market participants, from retail, from hedge funds betting against other hedge funds, and fully squeeze out all of the shorts out of their short positions, bring that short interest down to less than 1%. And we're actually seeing another major boost right now with AMC stock. This is my Robinhood small position in AMC I've had for a pretty long time now. Only had a couple shares, bought a little bit more, so it did average up on that. But anyways, let's move on to some of the option chain activities. So for December 17th, you're looking at calls in the money of 25,000, calls that are out of the money, 294,000. So right here, this controls 2.5 million shares that will have to be hedged for, and a potential 29.5 million shares that would have to be hedged for if all of these calls for December 17th ran into the money. At the same time, you're seeing much more puts that are in the money right now. 78,000 puts expiring December 17th and about 20,000 expiring this Friday, and this number has went down a lot. So like I said, as these puts run from into money out of the money, that's a lot of de-hedging, and that is really what is causing the move here today, as well as the puts that have ran into the money. Now, that's pretty much a given. January 21st, 2022, that's going to be the big day and the big day of real volatility heading into this new year. So keep all of that in mind. Watch for the puts to keep running out of the money, and watch for that correlation with the stock. On days we see the puts running out of the money, I want to see what is going on with the ortex estimates for the short interest to get a feel of if shorts are covering on an 8 to 9 or even 10% positive day, or if it is the option chain and FOMO buyers buying the stock that is causing the stock to move up. So let's talk about a little bit more of the technical analysis, and AMC is up 8.6%. Very strong day. Like I said, we need to break above the 200-day moving average, which is being our resistance level right now, and then make our way back up to $35 per share. Ultimately, I think this is where we will level out before we do see some of the shorts starting to cover. Once we get back up to, $45, $50 per share, that's where you're going to see a lot of these FOMO buyers head back into the stock, and a lot of that short interest actually get covered. Now, what is the intraday volume? The intraday volume is at 35 million. So it's probably going to be higher than what we have seen over the past couple of days, or close to what we've seen back here December 3rd when we did have 66 million in volume. All in all, I think this is a great sign that more apes are heading back into the stock. A lot of these apes, I don't think they sold out for any reason against AMC. I don't think they think the trade is not alive. I think some people had too much margin and they were forced to sell out. So all in all, very bullish activity that I am seeing. It looks like the hedge funds are in deep trouble, and it looks like AMC is going to go through an end of the year Moass or beginning of 2022 Moass. January and February, those are going to be the key months as well that I will be paying close attention to, where the buying power is actually coming from. So hit that like button for me. Consider subscribing to the channel if you guys want to stay up to date with everything that is going on, from hedge funds to other trades to AMC, anything that will help make you guys a lot of money. That is why we are here on this channel, to provide an open, honest, and transparent opinion on all of these topics. Like I said, check out the link for the buy and sell alerts and the link to go follow me over on Twitter in the pinned comment down below. I hope you guys enjoy the rest of your day. I will see you in later videos.